Well, my next guest has broken and entered and lived to tell about it. He is John Hammond, a senior security researcher at Huntress Labs, and he joins Eric Wade and I now to talk about the safety surrounding crypto investing. Eric Wade, of course, the editor of Crypto Capital at Stansberry. We want to talk to you today, John, about sort of the keys to hack-proof crypto investing. I did take a little bit of a Twitter poll on my own Twitter feed recently about what people's chief concerns are about crypto investing. And this was not particularly surprising to me, but security was at the top of the list. So I would ask you this: what is the best way, in your view, for a potential crypto investor to evaluate the safety of crypto investing?
Yeah, it's an interesting kind of problem to be presented with, right? Because we call this cryptocurrency, right? And that means it's built off of cryptography. So the technology, kind of the tech behind all this, is inherently secure. We talk about kind of technical jargon and gibberish between elliptic curve cryptography and all of that. But what that really means is that, okay, we have a secure technology because this is public and decentralized, and it's working with a lot of mathematical algorithms that can establish a proof of work that outlines that, okay, this new coin or this value of currency that we've created is depending off of all the previous blocks in the blockchain. And that makes it tamper proof. And with all those three elements combined, we can call that secure.
We hear about hackers taking people's cryptocurrencies, but we also hear it's unhackable. What do you say about that? How would you answer that?
Right. So we say, sure, this is some bulletproof secure technology, but that has its caveats, right? The thing is, it might be secure itself, but the way that we as people, right, the human element, we tend to make it vulnerable. And that's an interesting idea, right? So let's say you at home have a safe, like a physical metal safe, and you store all your money and your funds in that. And being a safe, it should be secure, right? Well, wrong, because you can open the safe. And that's a really weird thought, right? But if someone else can force and coerce you to open the safe, even though they can't themselves, well, that's no longer secure in a really weird way. When we talk about cryptocurrency, it totally changes the game in the way that we think about traditional and conventional money and buying and purchases. Because let's say you go to a store, right, and you want to buy something. So you bring that item to the cash register, the store clerk, the storekeeper, they're the ones that take your money and make sure, okay, they received it and they put it in their cash register so they can secure it. They've got their insurance to cover all the funds and they take a note of all the accounting and the ledger. But now with cryptocurrency, that third party, that external trust isn't there. And the responsibility becomes on you. Now the onus is on the user to make sure that's all secure. And that empowerment also means a lot of responsibility, and there could be some mistakes and accidents that come from that.
I wanted to ask you about one of the more prominent hacks we've seen with respect to cryptocurrency, and that was this $5 million hack of Ethereum Classic Network, ticker ETC. On a scale of 1 to 10, what do you think the likelihood of a hack of similar scale being perpetrated in the future against some kind of cryptocurrency? Do you think it's possible? And where do you think it falls on that scale?
Yeah, I don't think I would be able to nail it down to a really objective number, 1 to 10. I might land at a 7 and I might land also at a 5. I guess I can't say with that certainty, but the way that Ethereum Classic hack worked and how that happened is kind of fundamental to the way that blockchain and cryptocurrency works on its own, because we're talking about a decentralized ecosystem, right? So if you have that blockchain that's supposed to be secure, everything's built off another. That Ethereum Classic hack happened because there was a 51% vote or majority that this new established value is what's going to take precedence, because they were able to get more than half. And that only happened because that Ethereum Classic, that proof of work, the computational mathematics and the calculation that was required, well, that was a little weak and not as demanding as stuff like Bitcoin or some of the other cryptocurrencies. So sure, this could happen in the future. This could happen to other cryptocurrencies. It just depends on what it takes for processing power and resources. That's how we can define secure in that regard.
I have a question while we're talking about security then. You've said in the past the possibility that blockchain could profoundly alter the way banks do business and banking worldwide, including lower costs, increased security, making banking more accessible. And those sound like good things on the surface, but is there two sides to that coin in your mind?
There are two sides to that coin. I think one thing you might be alluding to is, okay, if we were to really establish this, if we were to lay this foundation and put together this central bank digital currency, right? Maybe get this in the ground. The central bank digital currencies differ from kind of what we know of Bitcoin and cryptocurrencies in their classic sense, because those cryptocurrencies are decentralized when the central bank digital currency will be centralized. Now, that might sound good because it gives the power to the central agency, the organization, the government, whatever it may be, to be able to control those funds, control that money and that value. That means that, okay, they can control what this means and add or remove funds from any account at the flip of a switch, whenever they'd like. That sounds great because it gives them the control, but interesting double side of that coin, right? That also means they have a single point of failure. Because what if that control is compromised some way, somehow? Okay, hackers are out there, they're doing their thing. That is some risk that we might have to look into more.
It doesn't sound very crypto, really, if you think about it either.
No, I totally agree. It's funny
crypto
when we
technology, but maybe not crypto ethos.
Absolutely. We start to get into more philosophical understanding and questions about security. It's interesting. It's really
who
cool.
owns the money at some point. That's where the rabbit hole leads down to.
Honestly, I think it all boils down to, it's interesting, sure, when we put in that philosophical sense, but we don't have to get into deep technical in the weeds jargon and nonsense about how all this cryptography might work. We talk about basic security, like you mentioned, the passwords and two-factor authentication, the simple stuff that we all have to do. And when I point back at that physical metal safe analogy, I hope that encapsulates it in a really good way, because sure, it might be bulletproof and all secure, but the human element, that's the vulnerability.
There's just no denying in this world, people routinely use and reuse passwords just over and over again. And so I have a question I think the audience would probably want to hear your take on. Do cryptocurrencies offer a higher level of security and therefore higher risk when something goes wrong, such as losing a password, losing a private key? And the real question then is, does that limit how many people really are going to be able to use them in the near future, in your mind?
Yeah, I think that gets back to the thought when we're talking about the blockchain and we're talking about it being decentralized and public and tamper-proof. That means that when something is out there on the blockchain, it's there forever. Can't be modified, can't be tampered with or changed. And what you end up doing or you neglect to do with your funds or your money, that has its own consequences. So sure, talking about passwords, talking about some purchase that we might make or the private key that you use to access your funds, we talked about those potential accidental malicious things that might make you lose your funds. Okay, the malware, the phishing scam. But even you store your private key on a USB drive and you lose the private key, you lose your USB drive. Those funds are gone. If you were to do that again, maybe accidentally have that typo trying to send funds to a wallet that never existed or that doesn't exist, that money's gone. I think you can actually see, and there's a lot of research out to see Bitcoin wallets that are vanity or fake burner accounts, and they'll just go into the void. It'll go into a digital trash can. So
that was an eye opener for me, the concept of burning and the idea that, you can be told over and over and over again, if you send something to the wrong address, you may never see it again. And then you find out that there are projects out there that intentionally burn coins, at the end of an ICO, or as a way to, have negative inflation or something like that, right? And then you start really thinking about that concept of a burn address. We're sending coins to this address intentionally because we know no one can access it today. No one can access it right now. I mean, the concept is it would take 10,000 years, right, for someone to randomly come across that. And once you hear that, and you really let that soak in, is that, okay, there's addresses that exist, but no one owns. And then you walk your way back from, better make sure I always know where I'm sending things, right? Or where I'm storing something, because I don't want to accidentally pick one of those, 10 to the 256th or whatever it is, addresses that haven't been a private key associated with it yet. They're there, but we haven't found them yet. So that's my reminder of, take good care of your keys and take good care of your password.
It just reminds me of my 13-year-old self who could never keep a purse in the right place at the right time. I would not want to trust that 13-year-old self with Bitcoin investing or anything of this kind. Well, guys, you have opened up my horizons quite a bit into the future. Thanks for joining me today.
Thank you so much, Jessica and Eric. This has been great.
And if you'd like to catch up with more Stansberry research content, please check these social media channels and find us. That's all for now. Thanks for watching. I'm Jessica Stone.